You're crossing the street. You look both ways. A car runs the red light and clips you. Now you're in the hospital with a broken leg, a $40,000 medical bill, and no way to work for the next 2 months. One moment you're fine, the next your life is upside down. And here's the thing, insurance doesn't stop the car. It can't prevent the accident. What insurance does is make sure you're not financially destroyed when bad things happen. Not prevention, recovery. Now let's slow that scene down and break it apart, because every piece of what just happened has a specific name, and your exam is going to test you on every single one. The car that hit you? That's the peril, the thing that actually caused the damage. And the pothole in the road that made you stumble a second too late? That's the hazard. It didn't hurt you directly, but it made the accident more likely. Peril is the cause. Hazard is the condition that increased the chance. Now imagine the pothole wasn't there, but instead you crossed without looking because you figured, I have health insurance, worst case I'm covered. That carelessness? That's also a hazard, but a different kind. And if you deliberately jumped in front of the car to file a fake injury claim, that's a third kind. Same crosswalk, three completely different hazards. And the whole reason insurance works at all, how a company can pay your $40,000 bill when you only paid $300 a month, comes down to math. They can't predict what happens to you, but across 100,000 people, they know almost exactly how many claims are coming. That's why your neighbor's house burning down doesn't bankrupt the company. They planned for it. But none of this works if people can insure things they don't own. You can't buy a policy on your neighbor's house and hope it burns down. You need a real financial stake, something to actually lose. Otherwise, insurance is just gambling with a better name. Let's put the official names on everything. In insurance, the direct cause of a loss is called the peril. Fire, theft, windstorm, collision, these are all perils. The condition that increases the likelihood of that peril causing a loss, that's the hazard. And your exam tests three specific types. Physical hazards are things you can see and point at. A cracked staircase, defective wiring, a dead tree in the yard, a missing smoke detector. If the exam describes a tangible condition of the property, it's a physical hazard. Morale hazards are about carelessness because insurance exists. Someone leaves their car unlocked in a bad neighborhood because insurance will cover it if it gets stolen. They're not trying to cause a loss, they just don't care enough to prevent one. The key phrase is indifference to loss. Moral hazards are about intent, staging a burglary, committing arson, filing a claim for items that were never stolen. This isn't carelessness, it's fraud. The line between moral and morale is the line between doing it on purpose and just not caring. The law of large numbers is the statistical principle that makes the whole industry possible. Flip a coin 10 times and the results are random. Flip it 10 million times and you'll land almost exactly at 50-50. According to the NAIC, the National Association of Insurance Commissioners, this principle of pooling similar risks across large groups is how every insurance product sets its rates. The key requirement is that the risks in the pool need to be similar. The technical term is homogeneous exposure units. Insurable interest is the legal requirement that you must have a real financial stake in whatever you're insuring. Your own house? Yes. Your business partner's life? Yes. Their death would cost your business. A stranger's property? No. Without insurable interest, the insurance contract can be voided entirely. It exists to prevent insurance from becoming a wagering contract. And not all risks qualify. Insurance only covers pure risk, where the only outcomes are loss or no loss. Your house either burns or it doesn't. There's no upside. Speculative risk, like investing in the stock market or starting a business, involves the chance of gain, and that's uninsurable. Think of it this way. Pure risk is a one-way street. You can only go down or stay flat. Speculative risk is a two-way street. Insurance only operates on one-way streets. Now let's talk about where the exam tries to trip you up, because every concept we just covered has a trap built into it. First, the definition of insurance. Your exam will offer insurance eliminates risk as an answer choice. It's wrong. Insurance transfers risk from you to the insurer. It doesn't make the risk disappear. The car can still hit you. Insurance just means someone else handles the bill. Transfer, not eliminate. every time. Next, moral versus morale. Here's the mnemonic that makes this impossible to get wrong. Moral, no E, think evil. Intentional, fraudulent, criminal. Moral E, with an E, think, who cares? Lazy, careless, indifferent. The arsonist is moral. The person who doesn't lock the door is morale. And here's the trap that catches everyone. Drug abuse, DUIs, alcoholism. The exam classifies these as moral hazards, not morale. It feels like carelessness, but the exam treats substance abuse as a character defect, a moral issue. If you see drugs or alcohol in a hazard question, the answer is moral. Remember that. For the law of large numbers, the trap is subtle. The exam will say, as the number of insureds increases, losses decrease. That's wrong. Losses don't decrease, they become more predictable. The number of claims doesn't go down just because more people are insured. The insurance company just gets better at predicting how many there'll be. Predictability, not reduction. Insurable interest has the most common trick question on the entire exam. When does it have to exist? For property and casualty, which is what you're studying, insurable interest must exist at the time of the loss. Here's a scenario. A woman insures her house, then transfers ownership to her ex-husband in a divorce. 2 years later, the house burns down. Can she collect? Think about it. She doesn't own the house anymore. She signed it away. So at the moment the fire happened, what was her financial stake? 0. She loses nothing if that house is gone. And for P&C, insurable interest has to exist at the time of loss, not when the policy was issued, at the time of loss. So no, she can't collect. The policy was valid when she bought it, but the moment she gave up ownership, she gave up her right to a payout. Now here's where they really get you. Life insurance is the opposite. Insurable interest only needs to exist at inception, when the policy is issued. That's why an ex-spouse can still collect on a life insurance policy after a divorce. The exam loves to mix up the P&C rule with the life rule. For P&C, at time of loss. For life, at inception only. And one more edge case on pure risk. Just because something is a pure risk doesn't mean it's insurable. War and nuclear disasters are pure risks. There's no upside to either one. But private insurers won't touch them because the losses are too catastrophic and unpredictable. For a risk to be ideally insurable, the loss has to be accidental, measurable, predictable across large groups, and not catastrophic. If the exam asks for a pure risk that is not insurable, acts of war is the answer. All right, let's put it all together. Here's a question in the exact format you'll see on exam day. A homeowner has a dead tree in the front yard. During a storm, the tree falls and damages the neighbor's fence. The windstorm is the what, and the dead tree is the what? A. The windstorm is the hazard, and the dead tree is the peril. B. The windstorm is the peril, and the dead tree is the physical hazard. C. The windstorm is the risk, and the dead tree is the moral hazard. D. The windstorm is the peril, and the dead tree is the morale hazard. The answer is B, and here's why. Start with the windstorm. Did the windstorm cause the damage? Yes, it knocked the tree over. So the windstorm is the peril, because the peril is always the direct cause. That eliminates option A, which calls the windstorm a hazard. Now the dead tree. Is it a human behavior? No, it's a tree. So it can't be moral or morale, because both of those require a person making a choice. That eliminates C and D. The dead tree is a physical hazard, a tangible condition on the property that made the loss more likely. If the tree had been healthy, it probably survives the storm. The dead tree increased the chance. Quick exam tip. When two answer choices look almost identical, like moral versus morale, the answer is usually one of those two. But this question's real trick was swapping peril and hazard in option A to see if you'd mix them up. Before this video, if someone asked you, what's a hazard, you probably would have said something dangerous. Now you know there are 3 types, you know the mnemonic, no E equals evil, with an E equals who cares, and you know that drugs and alcohol are moral, not morale. That's not memorization, that's understanding. If someone asked you why insurance works, you would have said they charge a lot of people. Now you know it's the law of large numbers, predictability across homogeneous groups. And you know the exam trap, predictable, not smaller. And if someone asked about insurable interest, you might have guessed you have to own it. Now you know it's specifically required at the time of loss for P&C, at inception for life, and that it exists to prevent insurance from becoming gambling. That's the foundation. Homeowners, auto, commercial, liability, everything from here builds on these 6 concepts. You don't just know the words now. You understand